My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Kramer. Welcome to Mad Money. Welcome to Kramer. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, to teach you. Tell you all about it. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. Next week, okay, right now, I'm declaring it an Nvidia free zone. The coverage of trading of this thing's gotten too much, even for me. We have to be able to focus on something else. Yet it seems the market only has the ability to focus on one stock at a time. And that's why on a day where the Dow inched up 4 points, S&P gained 0.70%, but the NASDAQ jumped 1.10%. I'm thrilled that we can actually look at other companies, even if they don't make accelerated computing chips that allow you to perform generative AI inference and be trained. Don't get me wrong. Even after Nvidia bucked the gravity of yesterday's sell-off, went up again today, I think it is headed much higher, which is why we own it for the Travel Trust. And I always tell you to own it, not trade it. But I think we can afford to give some other companies a little limelight, a little love, without betraying the AI colossus that I like so much. Fortunately, we have some very exciting companies reporting next week. Ones that revolve around whether the consumer's fatigued, maybe taking a break, trying to figure out what to do. We're not quite sure. On Tuesday night, okay, here's what happens. The holiday shortened week, which is terrible because I celebrate the holiday like everybody else, but I'll be planning. But I will also be doing the show in my sleep on Monday. Tuesday, here we go. We find out if Kava, the Mediterranean sensation, is deserving of its stocked 93% romp year to date. I mean, after all, Kava sells food, not high-end semiconductors, but this thing's been bandied about as the next Chipotle. So let's see what this Mediterranean restaurant chain has to say. Wow, what a monster. Okay, while we're at it, on Wednesday, we have to ask ourselves if Abercrombie & Fitch deserves to be up 70% for the year. It's got the right look. Its stores are always packed. It has eluded the accolades it deserves. Lately, though, I've heard people talk about how Abercrombie stands out. Oh, its stores are always packed. I guess it's only took a monster run of $30 to $150 over the past year to make the difference. 30 to 150. How's your index fund do? Sporting goods. It's been a pretty hot category of late for those broad-line stores that I've already reported, which makes me think that Dick's could have another good quarter, even as the stock's already nearly up 30% for the year. Now, it wouldn't surprise me if they actually put up some terrific numbers. I'm looking for some good golf numbers, too. I just mentioned a lot of non-tech companies with stocks that are doing very well. But how about an AI-centric enterprise software play that has historically put many other stocks to shame? How about Salesforce with a stock that's only up about 3% for the year, Matthew McConaughey? Isn't that incredible? Of course, in this business, people assume that if it's a stalled tech stock, then it's an accident waiting to happen. I think Salesforce is doing many things right, but it's not getting credit for it. Let's see if the streak changes. Oh, get this, Toast. You go to a restaurant and they put it right to the right in your face, and you put your card right in. That's Toast. Okay, Toast has an Investor Day Wednesday, and lately we've been hearing that things have slowed for the restaurant because of the number of customers. If Toast can dispute or disprove that, this stock is going to fly. Thursday, our investing club meeting. There I am. It should have Jeff Marks in there, too. We got to fix that. Get your questions to me and Jeff, and we're going to stay as interactive as we can with other members. How does your mutual fund interact with you? Maybe your index fund interacts with you. No, we do. We convene at noon. I want you to join. Now, Thursday's also filled with important earnings, mostly of the retail variety. When the consumer's stretched, you're supposed to buy the stock of Dollar General, DG. And I see no reason why that doesn't continue. I look for a good number. I like it here. Same goes for Burlington Stores, the off-price chain that's a little more pipe-racky. Ross Stores and TJX both put up tremendous numbers. I expect nothing less from Burlington, although I do think it's a little more downscale. TJX, charitable trust name, had an amazing quarter. Nobody cared because yesterday was such a bad market. Now it's beginning to get credit for it. I still think it's a terrific stock at 102. There are two challenge retailers that my charitable trust is positions in that I'm not telling people to buy right now. I don't expect anything good to happen. But we're sticking with them because with the trust believes that you have to be in early to anticipate the turnaround. I'm talking about Best Buy and Foot Locker. Both stocks act terribly, as I would say in my old hedge fund, which tends to mean that they're going to have some shortfalls. Probably will. Mary Dillon, CEO of Foot Locker, has prepped us for a tough quarter. Best Buy will be the recipient someday of the new wave of PCs with integrated AI come the fall. We want to get ahead of that because once they're in the stores, I don't think you'll be able to buy Best Buy at a 5.3% yield, which it has right now. Because of AI, we should have the biggest PC refresh cycle in history. Okay, maybe even bigger than the 90s. So I want that Best Buy exposure. But against that trend is the Home Depot-Lowe's conundrum. A lack of housing turnover. And a lack of turnover has hurt the hard goods segment of the U.S. economy and could hurt Best Buy pretty badly, too. Kohl's. All right, Kohl's is a difficult animal. It's rebranded as Kohl's with Sephora, and I bet that will begin to click, perhaps with this quarter. Bring your Kohl's cash. Cracker Barrel on the radar screen now after last week's radical analyst meeting where we got that huge dividend cut. I wonder if we can get a little more color or some reactions on the big changes when it reports this morning. I like what the CEO had to say, but Cracker Barrel will be a work in progress that we're going to chronicle for many years to come. After the close, two hero companies report, Costco and Dell. Now, I've found Costco one of the big three of the retailers. That's Walmart, Amazon, and Costco. The trust has a nice-sized position in the stock, and we believe Costco will report the kind of excellent number it often does when the consumer goes sideways. As usual, if you don't own it, please now wait for the quarter. The stock tends to go down initially on its earnings report and then rally several days later. Why is that? Because you pretty much know how they're doing, and it sells off when just kind of the non-news. Dell, I don't even know when this one will even pause. We have Dell envy at the Travel Trust, continually hoping it'll come in ever since we saw Michael Dell work hand in glove with Jensen Huang, the visionary CEO of Nvidia, at the GTC conference. Talk about getting right with Jensen. Dell's become the man to see to hook up your company to the new Nvidia supercomputer platform, also known as Blackwell. What else? Gap stores delivered an amazing quarter last time and then proceeded to take off like a rocket and then kind of crash like one, too. I think that there will be another great quarter, but no crash. Next, lots of people are trying to find proxies for AI, and Marvell Tech's name keeps coming up. The semiconductor company that gives the equipment that connects NVIDIA to the machines that devour its computing power seems very interesting to me. And if the rest of the non-hyperscale business, and a lot of it is just kind of plain old boring telco, starts turning up, $100. Mark my words. Earlier this week, we got some great numbers from Elf Beauty. Remember that? They sent its stock into the stratosphere. Many people seem to think that somehow it connected to the broader cosmetics industry. We'll find out when Ulta reports. But we keep hearing that Ulta's not doing all that well because it's being eaten alive by Sephora. Well, I think Ulta's a darn good company. I don't want to get in front of a potential freight train of selling here. All right, now here's one that I take personally because I like it so much. It's Cloudflare. Can they make a comeback? It's been down in the dumps ever since that last quarter. When CEO Matthew Prince gets in front of that podium from Investor Day, I expect he can tell a better tale than he did when that quarter was reported. If he does, then I say you got to own the stock ahead of the analyst meetings. It's feeling real de-risked at these levels. I like it. Bottom line, once the week's over, we're going to go full bore NVIDIA again. We just need a kind of a week to recharge. Then we can go back to focusing on the best stock that I have ever seen. It's been a total whirlwind move, but I remain steadfast. Own NVIDIA, don't trade it. I got to start in my home state, I think. Let's go to Alex in New Jersey. Alex.
Hey, Jim.
Alex, what's shaking?
I wanted to hear your thoughts on a stock that Nvidia invested in recently, Downtown. Hasn't moved much since Nvidia's earnings report, and just wanted to see what you thought.
Let's go with the recursion. All right, Dr. Chill wants to say this about SoundHound. It comes over constantly in what we call the crawl, and it's just because NVIDIA put the money in, and it has not meant anything, and I am not going to start making a mountain out of this particular molehill. Hey, you know what? Let's go to Millard in Michigan. Millard.
Hello, Jim. Thank you for taking my call. I really appreciate it.
Oh, thank you. What's going on, my friend?
Sure. I actually have a question about HPQ. This company, it's been like a 52 weeks high. And
right.
Honestly, my concern, we see that stock is not making any improvement.
I know. Well, it is straight up. It's straight up from 28. They do have the new AI PC. I think it could probably sell off. I don't know whether this is not the breakout quarter when it reports. The next quarter will be breakout. So I think if the stock goes down, then you want to pick some up. It's not Dell. That's the main thing you need to know. Dell is best integrated when it comes to NVIDIA, and you got to get right with Jensen. All right, listen to me. We need next week to recharge and then return. Hey, let's look at some other names besides NVIDIA. Although, of course, I will always keep one eye on that one. Oh, man, money tonight. UL Solutions, remember the old Underwriter Labs? Has soared since the safety science company went public last month, but nobody's talking about that. Ends tonight. I've got the CEO. To see what we can expect next from this new-to-the-tape name. New to the tape. I just thought of that. Then, if you're shopping for a turnaround story, I'm digging deeper into Macy's report this week to see if the new leadership has found the key to success for the brand. And maybe it's Bloomie's. Do not miss also another round of MI Diversified, where I talk to real people about real portfolios. Maybe we need to shake it up a little. So stay with Kramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Kramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Roughly 6 weeks ago, a safety science company called UL Solutions came public at $28 per share. Hey, this one, wow, popped up on my radar screen because since then, the stock soared almost 50% to just under $42. And when the company reported its first quarter out of the gate earlier this week, the results were pretty darn strong. So is this just the beginning, or do we need to worry that the stock's gotten overheated? Why don't we take a close look with Jennifer Scanlon? She's the president and CEO of UL Solutions to learn more. Ms. Scanlon, welcome to Mad Money.
Thank you, Jim. It's such a pleasure to be here today.
Well, we're thrilled to have you. You have a storied name. All of us grew up in my household and many others knowing that if we saw your Good Housekeeping seal of approval, it was the real deal. Now, we knew you as a nonprofit. That's changed, and it looks like that you're making a ton of money, and nothing's, I just say that it's still the most pristine name in the business. So tell us the evolution of what's happened here.
It is such a great story, and we were founded here in Chicago as a not-for-profit 130 years ago. And fast forward to 2012, we became a for-profit company under one shareholder, the not-for-profit UL Standards and Engagement. And we decided that the best answer for all of us was to take us public, which we're thrilled to be a newly public but not newly profitable company.
Okay, so why don't you go over, there's some very defined areas that you're involved with, but go over the UL Solutions overview with the revenue breakdown, which I think is interesting. It's a consumer, it's industrial, it's software and advisory, and testing, inspection, and certification, which is obviously really important.
It's absolutely important. And it's our mission to work for a safer world. And we aim to be our customers' most trusted, science-based safety, security, and sustainability partner. So we test their products, and then we provide software and advisory services to help them ensure that their products are certified and inspected and safer than they otherwise would be. So almost half of our revenue, 40+%, is for customers in the industrial space, business to business. The other ones are the customers working in the consumer space, business to consumer. And our software and advisory segment supports all of those customers across 35 industries that we serve.
Well, one of the most fascinating things I thought about you guys, big business in a place that a lot of people might think is not really concerned about safety, but it's really the opposite. China.
Oh, absolutely. You know, we've been in China for over 40 years, and China's important to the world's manufacturers. I mean, they're 30% of the world's manufacturing. And many of those manufacturers are looking to get their products into a North American market or a European market, and we're there to help them do that by testing and helping them prove to their customers that their products are safer and compliant with safety standards all over the world.
Now, we're talking about, people have to understand, 80,000 customers around the world. And I know that from what I can tell, you've got, I mean, I don't know how we can grade these things, but your retention rate among your top 500 customers is kind of extraordinary.
It is, because the great thing about our business is when you certify a product, you need to have ongoing certification services for the life that that product is in the market. So we have over 1,000 field engineers visiting every single one of our customers' manufacturing locations multiple times a year to help protect our customers and their manufacturing processes.
Now, I also know that you're totally up to date. One of the things that I spend a lot of time with when I'm out at NVIDIA is the digital twin. And I've always tried to figure out this digital twin manufacturing. How do we know if it's any good or not? You are literally redefining certification because you're actually grading a digital twin from Siemens, which is the #1.
Absolutely. And, Siemens is one of those customers. They've been a customer for over 50 years for us. And so we were thrilled when they came to us a couple years ago and said, hey, let's work together and think about how they can improve the speed of their innovation process on a complicated, expensive prototype. And so having that simulation, that digital twin in place with the application of all of our safety standards and our technical leadership associated with that digitization really allowed them to go through that prototyping process faster, get their product to market faster. And then the exciting thing is when they go to the all new and improved next round on that product, we've already done the bulk of the work. So we were thrilled to be by their side on this process and look forward to doing it with many of our customers.
But that is the most cutting edge technology in the world today. How does UL Solutions have people that know how to do this stuff?
Yeah, we have thousands of people who are technical leaders. In fact, 2/3 of our 15,000 employees have some type of technical certification. And a significant number of those people, over 1,000, are in our software engineering and digital organization. So the combination of our team, who understands how to digitize those safety standards and safety tests, combined with Siemens' team, who starts with their own digital model, it's a great exercise in both sides working together, coming together, and achieving a result that's beneficial to get their products to market faster.
One last question I had about the ownership structure. Will the big owner be periodically peeling off stock, or is that something that you would not know and they just might do it and they might not?
Jim, I've been a public company CEO before, and I have learned you don't speak for your shareholders. So they get to make their own decisions at the right time. But certainly there's great strategic alliance with our parent company. We have a single mission, working for a safer world. We were founded to do research on safety science, standards, public advocacy, and then test products for customers. It's a great enterprise, and we're really proud to be the commercial arm of it.
Well, you've been a terrific public company so far, and very exciting story that I candidly did not know until it was put in front of me. I did say to my staff, I said, oh my God, it's Underwriter Laboratories. That's the good housekeeping seal of approval, the real one. And it still is. I want to thank Jennifer Scanlon, President and CEO of UL Solutions, ULS. It was really great to have you on. Thank you for talking about your company.
Thanks, Jim.
Very good. Mad Money's back in for the break.
Coming up, department store redemption. Kramer crunches the numbers on Macy's turnaround. Next.
We know this is a tough environment for most retailers. We've seen that over and over again this earnings season. According to conventional wisdom, the department stores should be getting hit the hardest. But something surprising happened on Tuesday when Macy's reported a tremendous beat and raise quarter. That sent the stock up 5% in a single day. More important than the quarter, Macy's management told a great turnaround story. Remember, this was the company's first full quarter under the leadership of Tony Spring, who took over as CEO in early February and was appointed chairman in April. Before the promotion, he ran the incredibly successful Bloomingdale's division. This was also the first quarter after Macy's reached a détente with Ark House Management. That's an activist fund that teamed up with some other firms to launch what I can only describe as a combination takeover bid / proxy fight with Macy's board. It was all very confusing. Ark House did get 2 board seats in April, but it's a really big board, though. And the group still wants to buy the company. I mean, their last bid was $24 per share in March, although the company has cast doubt on their ability to get financing at that level. It's all very strange. Still, with all of that going on, this felt like a make-or-break quarter for the new management team, and they definitely made it. Macy's company-wide comparable store sales declined by 1.2%. Wall Street was looking for down 3.1%. When you look at only Bloomingdale's comparable stores, their sales were up 0.8%. Blue Mercury, that's their cosmetic business, that was up a strong 4.3%. Overall, total revenue came in a bit better than expected, and lower selling, general, and administrative expenses more than offset a slightly weaker than expected gross margin, what they made after subtracting the cost of goods sold. That translated into an impressive earnings beat of 27 cents per share, and us were only expecting 17 cents. That's why the stock really popped. On top of that, Macy's gave you very encouraging guidance for the current quarter and slightly raised its full-year forecast on nearly every line. All right, so how the heck are they pulling this off? When you read through the conference call transcript, there were a couple of key highlights. First, Macy's plans to rationalize its store count, then invest in refreshing the locations that it tends to keep open. At the end of last year, the company had 718 stores, including 502 Macy's banner locations. But as part of Tony Spring's turnaround strategy announced in February, they're going to close 150 of the worst performing Macy's stores by 2026, including 50 this year, which will allow them to focus their investments on the ones that remain. You don't throw good money after bad in the retail business. You put it where the good is. I think it's a smart plan. I think it's a bold move to cut bait on stores that just weren't working and really didn't have a hard. I don't know how you would ever turn them around. Now, as part of the rationalization effort, Macy's said it would start by updating 50 of the good stores. You know what they call it? The First 50 program. It's basically a pilot program. They want to figure out what works and what doesn't, and then apply those lessons to the other 300 locations that they plan to update. On Tuesday, we got our first report card on this First 50 program, and boy, I got to tell you, it's all A's. While the overall Macy's banner saw comparable store sales down 1.6% down, those 50 stores being updated had comparable sales of up 3.3%. That's a very big delta. On the conference call, Tony Spring explained exactly what they're doing at these 50 that are really working. Enhanced merchandising, rollouts of more elevated products, new marketing pilots, not to mention engaging live events, and additional services like personal styling sessions, fashion shows, beauty services, all of which boosted traffic and sales. It's working. Net promoter scores, NPS, for the first 50 locations improved dramatically. Overall, it's a very encouraging start for the Macy's turnaround. I like that. The second pillar of the new strategy is to, and I quote, accelerate luxury. Meaning management wants to improve luxury sales at Macy's locations, especially the First 50 program stores, and grow the company's other two banners, the upscale Bloomingdale's and Bluemercury, which is their high-end cosmetics and skincare concept. In terms of luxury sales, Spring said that customers were responding well to higher-end brands that Macy's either introduced for the first time or gave expanded distribution to, and there were a lot of new ones. When I looked them over, I was really surprised. As for Bloomingdale's and Bluemercury, they are doing very well. Spring said that, and I quote, the power of Bloomingdale's position in the upscale market is its diversification across categories and price points, allowing it to gain wallet share even as there are shifts in popular brands and categories, end quote. Bluemercury, meanwhile, had its 13th straight quarter of same-store sales growth, driven by continued strength in skincare and expanded distribution for popular beauty brands. Unlike the core Macy's brand, where management is eager to shrink the store count, they're actively looking to grow both Bloomingdale's and Bluemercury, but not in any sort of runaway fashion, which is good. Why shouldn't they put more on? The numbers are that great. Put it all together, and I believe Tony Spring can deliver on plans, especially when it comes to making the Macy's banner more upscale. Remember, this is the guy who previously ran Bloomingdale's, their upscale department store, which has been very successful for a long time, even when the rest of the business struggled. The flagship Bloomingdale's on the Upper East Side is so popular that there's often a line to get into the joint. Tony's now unleashed his luxury expertise on the entire company. I think it's a smart move, especially at this particular moment, when the consumer's weakness is mostly isolated to lower-end shoppers. You don't want to be in the business of cheap apparel right now, not when you have to deal with ultra-cheap competition from Asian discounters like Temu and Shein. There's a third aspect to Tony Spring's turnaround plan. He wants to simplify and modernize the company's end-to-end operations, basically back office cost savings. I thought they had already done this. I don't know. Macy's digital operation is under new leadership, but there's progress being made there, too. This quarter, we saw they're doing a great job of cutting costs. Several analysts called out the expense control as highlight of the quarter, even as it really isn't all that sexy. Listen, it's early days for the Macy's turnaround. Tony Spring's plan was only announced 3 months ago, for heaven's sake. It's going to unfold gradually over the next 3 years. I'm sure there'll be highs and lows along the way. But this week, we heard about a lot of progress in the initial few months of that effort. And I got to tell you, I'm feeling really good about Macy's. I mean, really good at this price. By the way, don't forget about that ARC House takeover attempt, which is still ongoing, even if it's somehow kind of on ice for now. I never recommend a stock solely based on takeovers. That's a fool's game. But it doesn't hurt them to have waiting wings if something doesn't go right. Bottom line, I see multiple ways to win with Macy's. Either Tony Spring keeps pulling off his ambitious turnaround, and I believe he can do it, or someone else comes in and buys the darn thing. Remember, ARC House and its compadres offered $24 per share, which is up almost 20% from where the stock's currently trading. Nobody believes that Macy's will sell. They shouldn't. But the fact that the option may be on the table gives you a nice fallback if the turn falters. Let's go to Philip in Alabama. Philip.
Oh, hey, Jim, this is Elizabeth, Philip's mom. We're on vacation in Lake Martin, Alabama, but Philip is, of course, thinking about his stock profile. So here's Philip.
Philip, how are you?
Good. How about you?
I'm doing fine. Thank you for asking. What's shaking?
Well, the other day at school, I got in trouble for looking at stocks, but my research led me to the Cheesecake Factory before I got kicked off my computer. I like the almost 3% dividend and current revenue growth. However, my dad is fearful of restaurant stocks. Do you think I should invest into this stock or go outside and play?
Holy cow. First, we're going to discipline that teacher who obviously doesn't have a clue about where you're going in life, because I can tell you you're going far. Cheesecake Factory has just come back down a little bit. Sells 11 times earnings. Got that great yield, as you pointed out. It always surprises me to the upside. I think you should own it. I think it makes a lot of sense. And I got to tell you, I'm going to pay you my highest compliment, Philip. You got horse sense. Let's go to Lori in Illinois. Lori.
Hello there, Jim. I'm just wondering about Chipotle. Do you think that it is going to do that 50-to-1 split? And do you think it's still a good buy?
I think it's a great buy. The split is going to bring in more people. By the way, the main reason they want to do the split, just to be really clear, is they want to be able to compensate employees with actual stock and not just like a quarter of a share, which is really smart. The guys who run this company, I'm talking about Brian Nickel, Jack Harton, they are about as smart as I've ever seen. And I think it is a buy right here. No, a strong buy. You got a winner. Let's go to Joel in Florida. Joel.
Jim, good afternoon. First thing I want to say is I'm a member of the investing club, and it's the best money I've ever spent.
Yes.
I've been listening to you for 19 years.
Woo.
And I've learned one thing. You're not a financial advisor. You're a financial educator.
That is so right.
That I have and what I can pick up from you and other sources, you've changed my entire life. And
I'm writing this
leave it
down.
at that.
I can't thank you enough. I had an existential crisis going into this weekend because I'm saying, listen, I want to garden so badly today. And then I am so glad I did not take the day off because I would not have gotten your call. So I completely am so thrilled that you called, Joel. How can I help?
I understand. You know, some of the things in my investing, I hate to sell certain stocks and I hang on to them. Well, I've hanged on to Adobe for almost 20 years. And it's been quite a ride for the last 20 years. Recently, you don't hear too many people talking about Adobe.
Well,
all the other AI things and so on. And yes, it's come off quite a bit, but, you know, it's still a great company. And I'm just wondering how you visualize Adobe along with all the other
Okay, I think there is a crisis. You know, to me, there's a difficulty at Adobe. I mean, let's take Mike Parsons' daughter, the designer. I mean, she switched to she has the full suite. She couldn't afford the full suite. I bought it for her. She was using Canva, which is not as good as Adobe, but the Adobe suite costs a lot of money. And I think that's what Adobe has to wrestle with. It has got a very expensive, but by far the best product. That said, Shantanu Narayan's going to figure it out. I bank with Shantanu. I think he's just very strong, and I really appreciate your comments. And I meant it about, I'm so glad I didn't take the day off, because you just made my weekend. All right, I see multiple ways to win by holding on to Macy's here, either through their ambitious turnaround efforts, or, and I hope not, because I want Tony to have the run of the joint a potential buyer. Now, Mad Money, lots ahead. We're going to play Am I Diversified, see if the portfolios of Kramer are positioned for success. It still matters to me as much as ever. Plus, where do we stand on the road ahead to lower rates? I'm revealing some signs to keep an eye on. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer. It's been a volatile, but at least satisfying week for the major averages. And with the bulk of earnings season now gloriously behind us, you need to make sure your portfolio is positioned for what might come next in this market. That's why tonight we're playing Am I Diversified? This is where you call me, you tell me your top 5 holdings. I'm trying to give you a little discipline here. Maybe I say your portfolio is diversified enough, or you have to mix it up a little. I want to start in my home state. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Kramer. I'm getting ready to do some surf fishing for stripers at Island Beach State Park tomorrow. I know you like to fish.
Well, I'll tell you what. I'm going to catch the ones that you throw away, and then I'll throw them away too. Because I have not caught one that is 36 inches in the last 5 years. Let's go to work.
Okay. This is my mother's portfolio, who's 87 years old, and I manage her account. Okay. And these are her stocks: Procter & Gamble, Coca-Cola, Cisco, Verizon, Berkshire Hathaway B. Jim, is she diversified?
Man, 87-year-old and just smarter than 99% of us here. Procter, you know, it's a charitable trust name. fantastic consumer product company. I do not regard it the same as Coca-Cola. They are different because this is a food company, food and beverage, fantastic, good yield. Cisco, that's Chuck Robbins, again, good yield. I do think that the Splunk deal is good, and the stock should have been higher after the last one. Berkshire Hathaway, no one's ever gotten going wrong with Warren. And then Verizon, I actually at one point or another would have said, listen, you do have to mix it up because I don't regard them as being a good enough utility for you to own. No longer utility, consumer packaged good, soda, tech, and insurance and diversification. That is perfect. Diversified company in its own right. Now we're going to Tom in California. Tom.
Booyah, Jim. Great
Booyah,
to be
Tom.
on the show.
What's up?
Yeah, my holdings are Tesla, Amazon, Thermo Fisher, Contour, and Coinbase.
Wow.
Am I diversified?
This is an interesting portfolio. Let's take a look at it. All right, Thermo Fisher is a scientific device company that is so good. We like Dan and her, but there's nothing wrong with Timo. Tesla, I tend to look at this company now as more of I'd say an autonomous machine company. That's the way I look at it. Autonomous machine. Contour, we know that's Lee and Wrangler. I love my Lee jacket. When I put it on, I feel like I'm a man of steel. Coinbase, yes, it's a company that does it's a bank mostly for crypto. And then Amazon is the world's greatest retailer, but also the world's greatest cloud computer company, and it's just amazing. So we're going to put that in tech. We'll put this in scientific device, autonomous machine, clothing, and finance. Bingo! Great portfolio. Great portfolio. Now we're going to go all the way back east. Holy cow, my head is spinning. Let's go to Rocco in New York. Rocco.
How's it going, Jim?
Rocco, this is just a great day because I'm planting my tomato plants tomorrow. So this is a great day. It's the eve of planting. How can I help you?
It's also the eve of my dad's birthday. Happy birthday, Dad.
Happy birthday to him.
Long-time Mad Money watcher, him and me. But my 5 stocks for you are it's KKR, Reddit, Waste Management, Shake Shack, and Meta. Am I diversified?
Man, our staff's put together some great people. I mean, of course, great people call in, so they don't have much to do. No, they do. They have to do a lot. Okay, Meta's Mark Zuckerberg's company. It's tech. Reddit is communications, and it is super. I was on it all day today. Shake Shack, obviously, just a great, vastly improving fast food company, which let's just call it fast casual. KKR is a amazingly good private equity company. It and Blackstone are the 2 that I'm recommending. And then WM, what can I say? Other than Temu and Shein, which I tend to end up there, I think they do they do a great job even when they have to dispose of those. So this is a waste disposal company that is fantastic, second to none. Fish doing a great job. Private equity, dining out, communication, and tech, and that is perfect diversification. We're 3 for 3 so far. Let's press our luck. Let's go down to Greg in Florida. Greg.
Hey.
Hey.
This is my favorite segment of your program. I really
thank you, Greg. That's why I'm so glad you're bored.
To the callers appreciate the insight into their portfolio.
Yeah, and people like to be on TV, and I love it when they are on. We're the only show on the earth left that puts real people on, and here we go. Let's go to work.
You are very correct. My 5 stocks today are Broadcom, Chipotle, Deckers Outdoor, Goldman Sachs, and Physical. Jim, am I diversified?
Wow. Man, this portfolio is so strong. Okay, Broadcom, we know that is going to be actually the best stuff that it does in tech is with Nvidia as partner, but it also does a lot of stuff in cell phone. Chipotle is the finest restaurant chain in the country. Sorry, Breaker, I love you, but it's true. Deckers is both Uggs and Hoka, and they had such a quarter. It was a blowout quarter on so many different levels. Vertex is CF, but they also have an anti-pain company, anti-pain formulation that is not habit forming, which is really amazing. And then Goldman's been the best performer of the finance. So we got finance, we got tech, we got restaurant, we got clothing, and we got drug. That is the picture-perfect portfolio. Greg's portfolio rocks. It just rocks. But you know what? We are so not done. We are now going to go to Lori in Connecticut. Lori.
Hi, Jim. Booyah!
Booyah, Lori. Let's hit me.
Thanks for taking my call. I'm a long-term watcher of the show.
Yes.
Thank you for all the hard work you do to help your Watchers make money.
Thank you. That's what I
You're
want.
welcome.
That's what I want. I didn't start out as a great investor. We're each helping each other. Let's go to work.
My 5 stocks are Amazon, Honeywell, AMD, Microsoft, Eli Lilly. Am I diversified?
All right. Lori asks a good question here. Now, we're going to let Amazon be a cloud computing company, accelerated cloud computing company. Honeywell, diversified manufacturer that we own for our charitable trust. Eli Lilly is probably, to me, the #1 drug company in the world. Now, this is what's important. Microsoft and AMD. We're going to have to make a choice here. We can't have both. We're going to have to say we want to keep Microsoft charitable trust name. We're going to have to go with AMD. And what we'll do, why don't we put in something that's just I've been looking at all day, okay? Let's put in Union Pacific, because that stock has come down far below where it should. It's just a nice change, added transport. I think it'll be a nice mix if we do that right here. You know what? I can't believe we're done. We had such unbelievable portfolios. It makes me feel so great. And thank you for everybody for saying that it's just a great thing that we do. We've been doing it since 2001, and I'm never quitting. Mad Money's back here for the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the light round. Good back there. We're going to start by so clear to close. And then the lightning round is over. Are you ready to keep that time? The light round. Let's start with Olga in Ohio. Olga.
Hello, Dr. Kramer.
Yes, Olga, how are you?
I have been listening to you for many years. Thank
you.
Do you remember the familiar sound of Polish Bujawski?
Yeah, maybe. I don't know. Well, go ahead. Go ahead.
Yes. I have been watching you for many years, and you are great for the little guy. You keep us going. You're the only one.
Thank you.
I'd like to know what you think about Moderna.
I still think that Bancel has it. I really do. I've been thinking this since 80, and I'm not backing away even though it's up here, and thank you for the kind words. Alexander in Georgia. Alexander.
Mr. Kramer, it's great to be on for a second time.
Oh, there you go. Number two. What's happening?
Absolutely. I'd like to gauge your thoughts on a company executing a roll-up consolidation within the United States mechanical, electrical, and plumbing sector. The company is Comfort Systems USA. What are your thoughts?
HVAC is king. I like Comfort Systems, symbol fix, I believe. And I like that company. Hey, how about we go to Steve in Virginia? Steve.
Yes, nice talking to you, Jim. I'd like to know about Sunoco.
I like Sunoco. I like this group. I would prefer to be ETP. I think that's the better one of them. The chart looks bad. I think it probably stops here at 7%. Let's go to Linda in Florida. Linda.
Hi, Jim.
Linda, what's
nice
up?
Talking to you.
Same. What's going on?
Show. Thank you. Yeah, I'm calling about a diversified company that has its hands in AI and has been posting great numbers and rising fast. But what do you think of Celestica?
Oh, my God, they're terrific. They're like J-Bill without any of the front office problems. It is just a great situation. What a comeback. It's been kind of in the wilderness for a long time, and now it's back, and it's still inexpensive. And then you go to Hunter in South Carolina. Hunter.
Hey, Jim. This is Hunter, obviously, from South Carolina. I was just going to ask you a question.
Sure.
I bought into AMC around $2.99, and I wanted to know if you thought that I bought a first-class ticket on a rocket ship to the moon, or if you think I should sell this kitty right now.
I want you to sell, take your capital out, and you can play with the house's money the rest. The balance sheet, even to the most recent sell of stock, is not good, and the box office numbers are horrendous. So take out your cash, let the rest run. Now I'm going to go to Margie. I hope I pronounced that right. It might be Margie in Connecticut. Margie.
Thank you, Jim, for all your investing wisdom over the decades.
Thank you.
I recently made a small purchase in uranium energy. I'm not a uranium geek, but I'm wondering if this is a reasonable choice or if there's something better in this arena.
Which one is it that you bought?
Oh, I'm sorry, UEC. Uranium
No, you bought the one I've been recommending. I think you're terrific. By the way, I think that Vernova is really good too. GE, they also are very big on nuke. Let's go to Juliana, and of course, Constellation Energy. Juliana in Florida. Juliana.
Hi, hello, Mr. Jim Cramer. It's great to be able to speak with you this evening.
Oh, I'm so glad you called. I'm so glad you called. What's up?
Thank you so much. I wanted to know your take on the company and the stock, Inspire Medical Systems.
Okay, now this is a company that should be making a lot more money than it is. We have to wait and see whether they can make money before we recommend it. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, don't be a one-and-done researcher. Kramer shares a strategy that'll keep you calm. Next.
Everybody wants to know if the economy is running too hot or if it's fine. That's the key to the Fed's next move. But we can't come up with a new verdict every darn day. We can't let a single errant brushstroke destroy the whole painting. Yet that's what's happening right now. Yesterday we had one piece of data, a gauge of services, a minor issue, by the way, and it was a little too strong. Interest rates immediately shot up, and then stocks instinctively went down. By the end of the day, it turned into a row, one of the worst we've had in a while. Tons of money vanished as plenty of people once again figured, forget the Fed, it's not going to help us this year. To which I say, enough already. I came up with the brown shoot indicators because I want us to base our judgment about the economy on what I call the preponderance of evidence. And the preponderance says the slowdown's coming. We've seen a bunch of signs that show it every day. Not every sign, but many more signs than a few months ago, which is what matters. So stop freaking out like yesterday and wake up to the idea the economy's not going to go from full-bore inflation to deflation overnight. It's a bumpy road. We have to continue weighing things, but not to the point where a single data point cancels out everything else that's been happening. Am I some dreamer betting that if we get enough brown shoots, the Fed will change its tune? Not at all. I believe that the economy runs on employment. As long as we have such strong employment, the Fed really can't get out of leaving interest rates higher for longer. The brown shoots that I've been looking at, from bankruptcies to freight rates to new business formation to food prices coming down, these are all about one thing, predicting when the layoffs will start. A slowdown doesn't start with layoffs. It starts with the decline in new businesses. People who are thinking of expanding, people who want to open a new company, they're the first ones to react. They're the first ones to pull back. Ladies and gentlemen, we're getting there. We're starting to see signs that small businesses have gotten wary about anything where there's price resistance in retail, groceries, clothing, even cosmetics. People want the cheaper. They want the generic. They want Walmart over Target. They don't want Lululemon anymore. It's too expensive. They'd rather have a cheaper knockoff. But they're still traveling like mad because COVID made us realize that life is too short, and that's still with us. But what would make travel stop, and why should we not worry about that? Well, the same thing we're trying to measure with the brown shoots. The next step after the lack of new business formation is layoffs, is firings, business closures. That's what needs to happen if you want the Fed to cut rates. We're going to see businesses fail because they couldn't get credit. We're seeing it happen right now in commercial downtown real estate. We're seeing it happen in restaurants. I think we'll see it in retail in a few weeks. Once it starts happening, we're going to discover something we didn't think possible. Residential rent real estate vacancies. That's right. Actual rent coming down. Sure, we got a ridiculous housing shortage right now, but when you lose your job, you can't afford to rent. So you have to double up. Maybe you have to move in with your parents, and that is how rents come down. Others may sell their homes anticipating a collapse in pricing. They'll move to units with less space. The home builders will lose their discipline, put up more houses, cash in before things go south. And there goes the final frontier of inflation. They can't repeal the business cycle, people, and the brown shoots can't be denied. So stop worrying that one number can upend everything else that's happened. The fight against inflation is going the Fed's way. Stop obsessing, and for heaven's sakes, stop trading. Like I said, as always, bull market, some of my problems. I've found it just for you right here, Mad Money. I'm Jim Cramer. See you next time. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Kramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Kramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.